Welcome to another explainer. Today, we're putting Eaton Corporation through the ultimate valuation test. We're stepping into the shoes of an expert investment analyst to run this industrial giant through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then we're going to cap it all off with a rigorous discounted cash flow analysis. Let's get right into it. So here's our game plan. We'll start with a quick company snapshot, look through the Buffett lens, move on to the Lynch lens, check out the Graham lens, dive into the DCF and alternate models, and wrap it all up with our synthesis and verdict. To set the stage, Eaton is currently trading at a pretty lofty $405.80 per share. This is a company riding some absolutely massive secular tailwinds right now. We're talking electrification, digitalization, and reindustrialization. But as we know, a great company doesn't always equal a great stock at any price, right? This really isn't just your granddad's old slow-moving industrial stock anymore. With a massive $9.55 billion acquisition of Boyd Thermal, Eaton is now heavily powering the glowing data center boom. I mean, their Electrical Americas segment just posted a staggering 42% rolling 12-month order growth, and that is driven largely by this unstoppable data center momentum. All right, let's move right into Section 1, the Warren Buffett lens. We're looking for quality and that all-important economic moat. Buffett is always hunting for a durable economic moat. And qualitatively speaking, Eaton definitely possesses a robust one. It's built on these incredibly high switching costs, deep regulatory expertise in intelligent power management, and super sticky defense and commercial aerospace contracts. Honestly, it would be nearly impossible for a startup to displace Eaton in a mission-critical data center or, say, a military aircraft. Running through the rest of Buffett's checklist, Eaton boasts a fantastic 2025 return on equity of around 21%, and that's calculated from their roughly $4 billion in net income on $19.4 billion in equity. Plus, management easily gets a pass for being so proactive in unlocking value. But there is a glaring failure here, and it's their debt. To fund Boyd Thermal and Ultra PCS, Eaton issued $8.5 billion in U.S. notes and $1.2 billion in Euro notes. Their long-term debt has literally skyrocketed from $8.76 billion at the end of 2025 to $18.54 billion by March 2026. And we all know, Buffett strongly dislikes heavy debt burdens. Looking at their approximate owner earnings through their net income trajectory, it's just a beautiful staircase of growth over the last 3 years. $3.22 billion in 2023, $3.79 billion in 2024, and $4.09 billion in 2025. This is exactly the kind of predictable, upward trending profitability that Buffett absolutely loves. So what's the verdict here? While Buffett would love the moat and the consistent earnings, he'd almost certainly balk at that massive debt spike. Valuing the owner earnings with his strict margin of safety, he'd probably pin a fair value closer to $250. At over $405 today? Yeah, there is zero margin of safety here for the Oracle of Omaha. Okay, let's pivot to Section 2, the Peter Lynch lens, where we're looking at growth and catalysts. As you might remember, Lynch categorizes companies into 6 different buckets. Historically, Eaton was just a reliable, slow to moderate stalwart, but right now, it's mutating into a fast grower. Q1 2026 sales jumped 17% overall, and management just raised their full-year organic growth guidance to a midpoint of 10%. That is incredibly fast for a hardware business. Let's actually run Lynch's numbers. If we take a forward price-to-earnings ratio of around 35 and divide it by that 10% organic growth rate, we get a PEG ratio of 3.5. Lynch considers anything over 1.0 to be expensive, so that's a red flag. Furthermore, the balance sheet is definitely strained by new commercial paper, and on top of that, it has massive institutional ownership, which Lynch actually views as a negative because it means the stock is completely discovered by Wall Street already. However, there's a flip side. Lynch would absolutely love their hidden catalyst, the upcoming Q1 2027 Mobility spinoff. They are essentially breaking up with their own history, divorcing their legacy internal combustion engine business to become a pure-play electrical and aerospace powerhouse. This kind of corporate divorce is exactly the strategic inflection point Lynch looks for to unlock hidden shareholder value. Still, at a 3.5 PEG, Lynch would rate this a hold, likely waiting for a price closer to $220. Moving right along to Section 3, the Benjamin Graham lens, where we get into the hard math. Let's start with Graham's defensive investor checklist. Eaton easily passes his tests for adequate enterprise size and long-term earning stability. It also has a really reliable dividend record. They paid out $4.16 per share in 2025. But, and this is a big but, it spectacularly fails his requirement for moderate valuation multiples. Graham wanted a PE below 15 and a price to book below 1.5. Eaton completely shatters those limits. But let's get precise for a second. If we strip away the narrative and apply Graham's famous, strictly quantitative intrinsic value formula to Eaton's 2025 numbers, what fair value do we actually get? Okay, brace yourselves because the math here is wild. Graham's formula is the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. So taking their 2025 EPS of $10.45 and a book value per share of roughly $50.19, which we get by dividing their $19.4 billion in equity by their 387.9 million shares, we get exactly $108.62. At $405 a share today, yeah, Graham wouldn't touch the stock with a 10-foot pole. All right, let's step into the modern era with Section 4, DCF and alternate models. Time for some forward-looking valuation. Since Graham's formula is backward-looking, let's build a forward-looking discounted cash flow valuation. We know management guided for 2026 free cash flow between $3.9 and $4.3 billion. If we take a $4.1 billion midpoint and project it outward using management's upgraded guidance of 10% organic growth for the next 5 years, we can really start to map out a remarkably robust cash-generating machine. Now, discounting those cash flows back to present value obviously requires some assumptions. So we've built a sensitivity table here, assuming an industry average weighted average cost of capital between 8 and 10% and a terminal growth rate of 2 to 3%. And as you can see, a base case with a 9% discount rate and 2.5% terminal growth yields a fair value of $190 per share. Honestly, even our most aggressive assumptions top out at just $265. And even when we apply alternate models, like comparable company analysis using historical PE and enterprise value to EBITDA multiples of its industrial peers, Eaton still appears incredibly richly valued. Those models suggest a fair value range between $280 and $320. The takeaway? The market is clearly pricing in a massive, multi-year AI data center premium that traditional valuation models simply can't justify right now. So, what does this all mean? Let's bring it all together in Section 5. Synthesis and verdict. This perfectly illustrates the tension we're seeing. When you consider the spread here, it's pretty eye-opening. Across the board, from Graham's ultra-conservative math at $108 to our forward-looking DCF at $190, all the way up to a Buffett-style owner earnings valuation around $250, Eaton's current $405 price tag drastically exceeds every single traditional valuation metric we threw at it. Therefore, our final verdict as an investment committee is a hold. Look, the underlying business is an absolute powerhouse. It has an epic $22.8 billion backlog, double-digit organic growth, and that genius mobility spin-off catalyst on the horizon. But as an investment today, the margin of safety is completely gone. Plus, commodity inflation actually pushed gross margins down to 35.6% this quarter, and that massive new $18.54 billion debt load adds real structural risk if the economy decides to slow down. These legendary gurus would likely sit on their hands and wait for a massive 30 to 40% pullback down into the $250 range before even thinking about deploying capital. But I'll leave you with this to ponder. Given those undeniable, massive tailwinds in global electrification and data centers, at what price does this industrial darling become a screaming buy for your portfolio? Think about your own margin of safety and let that guide you.